Vikas Khemani, good morning. Thank you for joining us. What has gone wrong with a lot of things in the market? Corporate governance, ADA group of companies, Tata Motors. We thought that this is going to be a great year because macros were looking great, crude had stabilized, but there are corporate governance issues. There are concerns on slowdown, and now there are concerns about how Tata group of companies or how Tatas have managed JLR.
Yes, Nikunj, I think we have had a very difficult market situation, especially in last 6 months. It all started with ILFS trigger off, and moved on to banking, NBFC banking sector, and there are lots of aftermaths of that. And I think in that sense, we have seen this before also. When things start going wrong, they unravel one after other. But I think having all seen that, now also another situation, if you see one side your markets are touching sort of close to new high, and other side you have number of stocks touching 52-week lows also fairly high. So I think it's a kind of characteristics of the market which is reasonable good liquidity in the market, but the confidence after the recent losses has been still missing. Macros I think are reasonably well placed, especially I think even if after the interest rates cut, I think we are directionally getting much better. I think we have one big event ahead of us, which I think is right now again not leading to creating a risk appetite in the market. So my feeling is that as we get closer to the election event, as we get little bit of clarity towards that, you will start seeing, and maybe in a decent manner post that event, we'll start getting some risk appetite back. But having said that, I'm not very bearish at the market. I'm not very believer that while things are slowly improving, it will take time for risk appetite to come back, for markets to come back in a meaningful manner, because even the tailwinds from the global markets also will take time to support. In a way, slowing down global environment is slightly positive for India, but still it's a deceleration of growth, and it's not a feel good factor all over. So I think this time around when India comes back, I think in my opinion it will be in sort of isolated market, or one of the very few market. And in this kind of environment, when you have to move ahead, it always takes a lot more firepower, a lot more to work for you to deliver, and that is not happening right now. In fact, we are having some bit of headwinds even locally in some of the issues you mentioned. So my view has been, and I think I continue to believe, that over next 3 to 6 months all these things will settle down and we will slowly start seeing an improvement. Yes, I think we expected a different kind of market, but markets always tend to sort of disappoint, and I will surprise you on many fronts. And I think that's the kind of market we are, and I hope that we don't have any more surprises in store, but those are things which are very difficult to predict.
But today you can't get your eyes off of Tata Motors. What a free fall this has been in. Do you catch a falling life? Do you finally believe that maybe this is the trough of it all, bottom of it all? Or do you think it's best avoided stories which have this global connotation, and we are seeing JLR beginning to get hit?
No, I think Tata Motors is practically a China story or a global story, not an India story, and we have seen this panning out over last almost a year, and has been slow and steady decline. And China situation is not really improving either. I think it's only kind of getting a little bad. So while I'm not expert on that, but I do believe that I think it will still take some more time for it to stabilize. I don't think we have seen pains over yet in that. I would like to see probably a few more quarters and then see how it goes.
Okay, fair enough. Where would you build your allocation or build your conviction in the run-up to the elections? In this window period when the budget is done, the RBI policy is done, and now people are really looking at the elections. I know there's one more policy in the middle, but even so, I think the focus squarely will be on elections from here on.
Absolutely. I think in this kind of environment, given the recent budget, I think one of the segment or sector which can hold on and do well also will be consumer staple. It is also a bit defensive sector. So all you look at is some kind of defense also in your portfolio should things sort of go wrong or not work out the markets are expecting. So I think that sector probably, that segment probably could do well despite all the valuations which are there right now over next 3 to 6 months. But from a long-term perspective, I think in my opinion, time has come to start looking at nibbling, some of the mid caps, and we have seen a massive carnage around that. Confidence is low, even if business fundamentals have improved as compared to last year, we are seeing prices which are like 40, 50, 60% lower from the highs. This kind of characteristics is very good in my opinion, for picking up the stocks where business are all right or steadily improving, but because of market situation you are not you're getting them at a much reasonable price. So I think and you have to obviously space it out, in my opinion, do kind of systematic investment plan on that. But I think time has come, in my opinion, looking at the valuation, looking at the risk reward, to look at some of the mid caps segment. Other sector which I have always been positive and I continue to remain positive is private sector banks. I think the shift of market share from public to private will continue. Balance sheet repairs have by and large happened, and I think especially the corporate facing private sector banks will have a spectacular time over next 3 to 4 years, and valuations also fall, are kind of favoring you in that segment. So I think some of these segments or sectors are my favorite right now. One more segment I probably might want to say is capital expenditure is picking up both on infra and private side, and industrials and capital goods companies I think are likely to do better. We have already seen commentary coming from companies in terms of improving order book, improving demand outlook, and despite all the global weak scenario, domestic demand outlook seems to be quite decent. So that segment also where you can deploy serious money is also there to look at.
I just want to mark the market breadth once again. The market breadth frankly has been this irritant that Nifty is holding on, market conditions are not that great, and market breadth is sketchy. Bharti Infratel and Bharti Airtel, I want to mark those two stocks. I mean, do we have a bottom in telecom stocks? Well, I mean, if the price war fear is getting over, and if there is a scope for a little bit of incremental price uptick happening somewhere in the second half of this year, then obviously some of these companies would have a huge pent-up benefit going forward. Because my immediate follow-up question would be that we've not seen Nifty mein mandi, right? The benchmark indices are still holding on. Institutional activity is still okay. FIs are buyers on one day, they're sellers on next day, but there is no mass exodus at the DI front or at the FI front, and Nifty is still holding on, and nobody is feeling excited about this market. So I just hope not, but imagine a scenario where institutional investors, they start selling and Nifty starts cracking. What happens then?
So I think Nikunj, very good question, and I think that should also, I think, in my opinion, we have seen lots of worse event in last 6 to 9 months. Despite that, we have not seen SIP inflows coming down into the mutual fund flows. Despite that, we have not seen FI flows coming down or going majorly out from a country in this period. It just shows that there is a long-term belief in the market, in the asset class, in the country, from a returns perspective. Right now we are in a tricky situation, hence most portfolio managers are trying to remain invested into liquid and large cap stocks. Their ability to, because still environment is uncertain, one is not sure, should like the same, like you are worried that what if outflow happens, how the portfolio manager will return, without having significant impact on the portfolio. So, and everybody is kind of prepared with that kind of situation, and that is giving them, forcing them in some sense, I would say, to put money only in the large cap. Because when you are a fund manager, all you care is if tomorrow, if you perform reasonably well, but you need to be prepared for the liquidity exodus, right? So I think that's the kind of psychology of most of the players I see currently, and it's not wrong. That's how situation is right now. But that is also creating an opportunity right now in the other spaces where mid caps are fairly cheap. So I would say this can continue for some more time, and the divergence which has happened between large cap and mid cap is characterized by the current situation of good liquidity, bad kind of environment, bad risk environment, and I think it will change as we settle down the environment slowly in next 3 to 6 months.
Because in this market, are you fully invested or you're sitting on some cash, both for the private capacity and also in the listed capacity?
No, I think it's in this kind of environment, one one needs to have little liquidity. I think you can. You should not be fully invested, because I think you are every single day getting some of the new opportunity. But I think time has come to start having a planned deployment. In my opinion, you should keep on now looking at over next 3 to 6 months in a systematic manner. And still, market can surprise you. Look, market can never, it can never be a guarantee that you won't have downside from here. Some, factor might happen. But from a risk reward perspective, if you look at, and if you have slightly longer time horizon, I would like to say that one should remain fully deployed over next 3 to 6 months.
Okay. Okay.
Fair enough, because we didn't touch upon your reaction to what the RBI has done with that first rate cut, at least in this cycle that they've initiated. How many more to come? How much is the industry expecting? And what would that do for the overall earnings number? Because I know that a large part of why the Nifty is sitting at 11,000 is based on the premise that we are pretty much likely to see that major earnings revival, the much awaited earnings revival to come through this year.
I think it's a very good move by RBI. Our real interest rate is way higher than what it should be. I think there's a lot more scope to cut, over next 3 to 6 months. Obviously, the RBI will watch out the environment globally as well as locally. I think they've changed their stance to neutral. I'm sure we have at least over next 12 months another 3-4 rate cuts, in my opinion. This also kind of assumes that global environment will remain the way it is right now. So I think directionally it is very good move. We much needed move, and earnings impact typically tends to come with a lot of lag. 25-50 basis point cut won't have immediate impact on the earning, but at least good part is that it will have impact directionally on the demand. So I see that and we have had huge amount of disappointment on the earnings front for many years now, and we can only hope. And I believe that don't expect miracles on the earnings front even next 1-2 quarters, because in a very volatile environment, both from a demand perspective as well as the currency volatility, raw material price volatility, it's very difficult to maintain the momentum on the earnings. You won't have that. You need a reasonably good tailwind from a lot of factors to have a sustained earning growth, and we have not had that for quite some time. So don't expect significant revival of earning across the board over, in my opinion, next 2 quarters also. But it is slow and steadily on the mend and in the right direction is what I would say.
Okay, Vikas, great to have you on the show. Thanks much for taking the time out and speaking with us today. That's Vikas Khemani on a whole host of views, not just on the markets, but individual stocks and sectors as well.